Tesla's up 2,000% since 2019. So is this ever going to end? Well, in this video, we'll use Tesla as an example of a complete way to analyze the stock and the company behind it. Now, the global automotive market is slightly bigger than $2 trillion, slowly growing at 2.8% annually. Electric vehicles are only a fraction of that, $255 billion, or 12% of the total market in 2023. But the growth is expected to be 23.6% annually. So in 2032, the balance will change. The $1.7 trillion electric vehicle market will make up 64% of the total automotive market. So will Tesla remain the main player? Well, first and foremost, when you look at any company, it's more beneficial to be on a trending wave rather than fighting headwinds. Now, in this case, we can clearly see that Tesla is in the tight segment. Compound annual growth rate of the market segment is sometimes more important than financials, management, and product quality. The power of trend is enormous, and it can't be downplayed. I know, I'm repeating myself, but if the company you want to invest in operates in a dying environment, nothing they can do will have any real impact. Now, that's the first part of our checklist of analyzing a company. You can download it for free. The link is in the description. And please subscribe to the channel. Next week, we'll talk about how the greatest hedge fund managers time the market. Michael Burry got 2008 right, so timing the market is not a myth. Now back to Tesla. The target Tesla customer is quite an established person with a pretty high income. Now that segment is very generous, but also very demanding. Tesla is competing with Mercedes-Benz, Audi, and BMW. Currently, most of Tesla's growth is in China, which is a worrying sign for a company operating in a growing segment. Now, obviously, we don't know the market stats as well as they do in Tesla, but there is one indicator that shows the company's perception of demand quite well. Yeah, we're talking about the prices. Tesla makes a lot of headlines with the price cuts. Now, usually discounts and price adjustments are a marketing strategy for plateaus. Having to apply stimulus on a market growing at 23% annually means the company is having demand problems. Now, currently, all the hopes are coming from the Chinese market. Tesla has increased production greatly, but at the cost of a price war. And CEO Elon Musk said further price reductions are inevitable. The company is clearly putting sales volume ahead of earnings. Now, there are two reasons for that. First, the subsidies. In the U.S., Tesla benefits from a $7,500 subsidy per each produced vehicle. Now, the second reason is the launch of subscription services for the installed software. Now, Musk clearly sees Tesla as an iPhone on wheels, and he believes the company can generate software revenue in the nearest future, but we're not there yet. Now, let's have a look at competitors. Now, my biggest concern is the amount of models. Now, market leaders usually introduce a new platform generation every 10 years. Now, the platform can be adjusted to produce dozens of models. Mercedes-Benz, for example, has 21 consumer models. 2 of them are electric. Now, the models cover multiple target audiences. And there's the commercial vehicles as well. Tesla, on the other hand, has only 4 models, with Cybertruck on the way and semi-trucks starting their market journey this year. Now, it's not enough to compete with the big brands that are able to introduce style adjustments every year and a significant model update every 2 or 3 years. Tesla has been reluctant to upgrade Models 3 and S, which are basically the same cars introduced 7 and 10 years ago, respectively. The major difference is software, but these cars are way behind in comfort and in interior quality. Now, it's not EV versus fossil fuel cars anymore. Every major producer has EV models now, so it's essential Tesla starts to update the models they produce. Now, in our checklist, we have the market forces section that'll help you identify the competitive positioning of the company you research. That is probably why Merrill Lynch has projected Tesla's market share to go down to 18% by 2026. In 2018, it was 78%, and last year they had 62%. So, what is the key competitive advantage of Tesla in the environment of fewer models of lower interior quality? Well, Musk believes software is the key. Autonomous driving, integrations with solar hardware, and services like Spotify are supposed to attract new generations of customers that are strongly attached to their gadgets and social media. Well, the conflict is the Y generation is way poorer than the X generation that is currently the main customer base of Tesla. And Gen Z is set to possess even fewer things in the world of high rates, inflation, life balance ahead of work effort, and sharing economy. Older generations value style and quality, hence the rapid decline of Tesla market share since the introduction of electric models from the traditional brands. In China, the government's support of automakers helped BYD become the world's leading EV producer. Now, the overall assessment of long-term market perspectives is not really favorable for Tesla cars. The producer will be forced into a niche by bigger brands, but they act as if they're going to dominate the market. Tesla should be investing in new models and quality more than into price cuts. Now let's talk about the fundamentals. Tesla is looking great right now. The revenue has been growing, which leads to a 51% growth in 2022 and 70% growth in 2021. Now, the company became profitable 2 years ago, showing an amazing 127% profit growth last year. The margins are quite healthy too. On an annual basis, we see 25.6% gross profit and 15% net profit margin. But there are worrying signs too, and that's a reflection of the price cuts. Having peaked in late 2022, operating income has dropped from 16% to 11.4% in the first quarter to 9.65% in the second quarter. That's the main factor responsible for the major pullback of Tesla stock after the earnings report. Analysts expect it to drop even further. The cost of revenue is simply too high, and it's hard to see how it goes down. Of course, the stock is quite different from the business it represents. The stock price is more about belief in the bright future rather than the reflection of the past. Tesla stock was always ahead of itself, so let's have a look at what fundamental factors can help improve the bottom line. First, the introduction of semi-truck and Cybertruck. Now, the two models are expected to generate an extra $8 billion and $22 billion by 2025, respectively. Now, hopefully, without any price cuts. This will add 30% to the current revenue in the next couple of years. Second, an expected switch from lithium to sodium batteries. Now, lithium has become extremely expensive since the start of the EV boom. Tesla is looking to save money by switching to alternatives. Sodium batteries won't have the capacity of the lithium ones. The maximum range will drop below 200 miles a day. Now, introducing a new budget model might help the company sustain a healthy cost of revenue level. Third, diversification into energy and services. Now, Tesla expects to launch a new chargers business with an upside to grow into a $20 billion business. Building the infrastructure can help the company in the long run, but the margins of this business will be quite small. We should also mention the megapacks here, the backup battery systems for utilities. The company projects a $400 billion revenue by 2030. Now, finally, the big one, the autonomous driving market. It's set to reach $2 trillion in the next 10 years. This could be a gold mine for the company, and Tesla is ahead of the market in the way they approach the challenge. Selling the software to rival companies could help them drop automotive production completely. Why bother? Now, to finalize fundamentals, as much as we think the core auto-producing business is in danger in the long run, the new revenue streams from infrastructure, energy, and software provide a bright future for the company. Now it's time for the trader's crowd wisdom. Let's see how Tesla stock is set ahead of the challenging transition from an automaker to a software and energy company. Being quite a volatile stock, Tesla has a lot of speculative bets around $660 and $800. Now, that doesn't really mean that these will be reached by January. However, keep in mind that support is around $180, which gives space for a further 25% pullback. June 2024 looks positive too. $400 and $500 price targets show risk appetite among Tesla fans. October bets, however, give an indication of going further down to $220 and resistance at $260 and $290. Same as fundamental data, options accumulations show a likely brighter future in the long run rather than in the near future. Visual sectors is the perfect answer to the win question. We help retail investors understand key trends in the market, and our data sets put a calendar date on them. We source the most complicated data from Standard & Poor's, FactSet, and Options Pricing Reporting Authority to turn them into easy-to-read charts with up to 72% win rate based on 10-year back test.